Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Arjun Choudhary. Now, Arjun is the VP of Investments for Onicx Group, a Tampa, Florida based full service real estate development and construction company. The firm was launched back in 2004 and honed their expertise in developing and building healthcare, multifamily, and industrial properties, and has a core mission to profitably acquire, develop, and manage commercial properties across the Southeast. And so, guys, with that, it's my honor to welcome Arjun to the show. How you doing, my friend?
I'm good, Kevin. Thank you for having me over.
Excited to have you here and excited to learn more about both yourself personally as well as Onicx as a firm. But let's start with personal. So I gave that very brief introduction, Arjun. Do me a favor, and if you would, maybe take a few minutes, tell us a little bit more about yourself, your background, your expertise, and ultimately, how you landed in your current role with Onicx.
So I was born in India and I studied architecture at the undergrad level, practiced architecture in India for a good 4 or 5 years before I went over to the UK, practiced there in London for a year. And my intent was always to get into real estate development, either through acquisitions or just ground up development.
Mhm.
And I targeted business schools all across the US, especially in fast growing markets. So University of Florida was obviously right up there. I got a really generous scholarship from the university, and it made the choice a lot easier. And I do not regret it one bit. But going to business school really rounded out my skill set. I was already good at understanding the hard assets of development, the process of development. Then I tacked on skills in terms of understanding finance, and investments. Not that real estate finance and investments is the hardest class to do, really, as opposed to most other finance programs, but rounded out my skill sets there. Onyx was amongst the three other companies that at that point of time were looking for a candidate like myself. The CEO of Onyx made a compelling pitch, and we were very nascent back then. We had a portfolio of about 4 buildings, which where the occupancy wasn't very strong. All they were medical office buildings. I joined them, helped them build out, the multifamily vertical, the industrial vertical, and expanded significantly on the medical office side. So that's me at a personal level.
Okay, no, fantastic. And I saw in your bio that you also, during one of your tenures at, I guess when you were still in India, that you also designed and developed missile storage facilities. Tell me about that. That
Yeah,
is unique in nature.
yeah. I mean, I got stuck in a very interesting position there because the senior leadership of that firm that I joined back then left, and I was almost very new out of college at that point of time, but it was a lot of coordination work. So I very quickly I realized that the real world works mostly on human relationships, and if you can manage human expectations or not. And this was for the Defense Department of India. So it was an interesting opportunity. It was a big opportunity, but from a technical perspective, they were very challenging. It was more an engineering exercise than a design exercise. But I mean, it's a different world when you think about stuff like that. If
Sure.
there are bomber aircraft that are flying over, an area that you want to kind of make look just like land. So you have these huge bunkers with grass on top, and if you're flying above, you can't figure it out. And apparently,
Sure.
that's good enough.
Yeah, yeah, no, that's very interesting. And so let's talk about coming on board there with Onyx. You'd mentioned that they had a healthcare portfolio of 4 properties that were experiencing not so great occupancy numbers, and ultimately that was one of your projects when you came on board. Talk to me about obviously the challenge was the low occupancy, and so I'm sure there's much more to it than that. But ultimately, talk to me about the challenge. Ultimately, what strategic plan you brought forth, and how you're able to ultimately succeed at, getting the occupancy increase and ultimately expanding upon that portfolio.
Yeah, so this was back in 2017, and
Okay.
interest rates had gone up marginally at that point of time. But the things that I did with the portfolio at that point of time that helped significantly, one was that it's spec spaces. So the space that was entirely built out and ready for potential tenants to walk in, look at, and say, "Hey, I like this space. I'm going to take this space." You can charge a premium on top of that marketed rent because it's a built-out space. Money's already been spent. They're not spending any more money on tenant improvement in terms of an allowance or anything out of pocket. and you can charge a premium on the rent. So that was one way where we kind of hasten the process of the lease up. And the other thing that we did was start working with local brokers. I mean, we still work with national and local brokers, but local brokers somehow have a better pulse. And it's not a knock on the JLL, CBREs, Cushman,
Sure.
Wakefields of the world. They still do a fantastic job, and they still work. We still work with them. But it's sometimes it behooves us as the owners of the building to actually work with folks who are born and brought up in a particular sub market, and all our assets were class A, but it was just in markets that were up and coming back in 2017. Now, fast forward 5 years, we managed to sell two of those buildings after leasing them up to 100%. And of course, back in 2017, 18, 19, 20, we started refinancing our assets so that the cost of capital went down. It cash flowed nice enough for the investors, and you could make some capital improvements again in the form of spec spaces to expedite the lease up, and it worked. It took a while. It's not a quick process.
Sure.
I would say a good 2 years to kind of just get our arms around it.
Would one argue that there was potential risk with the building out of those spec spaces? Obviously, you guys are front loading, you're spending the money, and with no surely guarantee that you're going to attract the ideal tenant. So how do you weigh that risk reward scenario?
Yeah, it's so medical office is unlike most other asset classes. It's very dependent on the location, obviously, like every other form of real estate, but because all our assets were on campus, the location was obviously top tier. The second thing was like the lack of preparation on potential tenants, and usually it's doctors. And doctors usually, when they look at their own respective leases, no matter where they are, they look at it only 6 months before finding out, all right, my lease is going to end. I need more space. I need to expand. So we kind of spotted that pattern very quickly and said that, all right, our clients are not very well planned. They won't give us, the 9-12 months required to kind of design, permit, and then do the build out. They want it right now. They don't want to wait like several months for it. So we basically kind of bet on that. You're right. There was definitely a risk associated with it, but we put the cost of capital, the equity, and the debt, and knowing what the returns might be. And at that point of time, things seem to have penciled out, and we've done that now over several hundred millions of dollars worth of medical office buildings over the last better part of a decade.
Yeah, no, I appreciate that. And talk to me about Onicx as a firm today. Where is the majority of your focus and time spent?
I mean, we are heavily focused on healthcare real estate right now. We have a development pipeline of about close to $200 million of ground up medical office buildings all across the Southeast, and one in Texas. And we spend a lot of time, making sure that our healthcare vertical is really strong, to the point where now we are soliciting almost a programmatic partner, if you will, at the institutional level, to come up with about $300 million in equity, recapitalize the existing portfolio, and then use some of that money to do the ground up development projects and also go on and acquire new assets. It's something that we've been working on for the last year and a half. I mean, now I think the strength of the asset class will really shine through, given that most other asset classes will struggle. But we are also super active in the industrial space and also in the multifamily space. And that has more to do with the fact that, just Florida has generally grown a lot. And through COVID, it grew a lot faster than it was already growing at. So that's how we kind of, picked and chose our targets. But all our projects are in really strong locations with really strong equity partners and banking relationships that we've developed over the years.
So speaking to, you mentioned the other two asset classes that you guys specialize in, multifamily and industrial. Just, as we find ourselves, one would argue that we're in a recession, that we're entering into recession, right? Just really depends what camp you're in. One can not argue against the fact that ultimately, the capital markets have seen quite a bit of volatility here over the last couple of months, and that, given the feedback from the Fed, that we will continue to see some turbulence here over the next year and probably thereafter. And so, with all that being said, obviously, industrial, all the three asset classes that you guys specialize in, medical, industrial, multifamily are all have been just huge winners. For the last 3, 5, 10 years, for the last decade, they've been huge winners, and so it sounds as though you might be you still believe in all three of those asset classes, but you're really putting maybe more of an emphasis on the medical office than of the other two. Is it because you see that it's much less of a risk here over the coming years than multifamily industrial? And if so, why?
That's a very interesting point, Kevin. So the healthcare platform was always going to go in this direction. I mean, it's
Mm-hmm.
just that the fact that the timing of our activities kind of synced up with what's happening with the market. But there really wasn't an intent initially to kind of time the downturn with a focus on healthcare.
Gotcha.
The focus on health, the activity on the healthcare platform started simply because we needed more equity. So that was the trigger for us. And as far as the general narrative that goes, I mean, in California, you're already seeing double digit, concessions, discounts, and value drops. In Tampa, Florida, Central West Florida, it's maybe 1 or 2% at this point of time. I'm not saying that won't get deeper. That might get deeper, but again, historically speaking, recession lasts 8 months as opposed to like the upswing which lasts about 9 years, and that's
Mm-hmm.
that's for the last 7, 8 downturns that we've seen. But we don't we do anticipate a decrease in rent increases on the multifamily side. So you're not going to see 4%, 5%, 6% hikes in rental rate on multifamily, but on the industrial side you will continue seeing an uptick in terms of just like the rental rates, because it's a change in how we behave as a society. We're buying more products online, and also not just that. More and more smaller shops are looking to set up their front office in front of a warehouse and have their stock right behind it. So it's an adaptation of the new world that we live in.
Mm-hmm.
And really, I read this stat somewhere recently that between Tampa and Orlando, the I-4 corridor, the amount of goods that are carried is the GDP of France. Think about that for a second. Like
Wow.
that's incredible that's the level of business that happens. And there's an acute shortage of inventory, just generally speaking. I mean, there are multiple studies that will show that the housing deficit is going to remain to the tune of 30,000 units for the next decade. And even
Mm-hmm.
at the end of the decade, it's not like the problem would have been solved. So we have, I mean, at a high level, we are not trying to time the market, if you will, on any of those asset classes. We are developers. We find the right equity partners and the debt partners to kind of work with us on the asset classes and the location that we believe in, and when we have a business case, and that is defensible. And at the end of the day, when the next boom comes and we are in a position to sell, we line up for that
Yeah.
instead of trying to be like, is this the lowest or is it going to get lower? And I do believe it's going to get a little low before it comes back up again.
Mm-hmm.
2023 is definitely going to be a year full of challenges, I'd say.
Yeah, no, I agree with you. And you're just speaking to your equity and debt sources for the most part. At least speaking to the equity side of things, is it retail investors, or is it predominantly family offices and institutional capital coming your way?
It's a combination of all three.
Okay.
So, we've got friends and family that, each investor puts up anywhere between $50,000 to $500,000 per deal. Family offices, depending on their outlook, do anywhere between $5 million to whatever the whole LP position is that's available to them to take down. They take down both. And as far as institutional grade investors are concerned, we've worked with private equity groups, not as many as as large as the KKRs or the Investors or the Wafras of the world, but we're getting to that level slowly on the healthcare side, and hopefully by the end of Q1 next year we'll have an institutional partner on board for our healthcare portfolio.
Yeah. Talk to me about the chatter inside your company internally, as far as strategic plans to again navigate some of these bumpy times. We know that the emphasis is really going to be focused on the healthcare division of your group, but just really managing any turbulence that might come your way. What are there any strategic plans in place, and if so, what do they look like?
I mean, from a strategic plan perspective, the one thing that we're focusing on this December as we prepare for 2023 is list the projects in order of, the highest probability of actually getting executed in 2023, and double down on them. Because, our deals are all the deals that we've underwritten are superbly strong, but some, I would say, present a stronger case than others. And the likelihood of investors biting off on it, or even debt groups biting off on them, are high. I mean, medical office, you can raise money for it all day long on phone calls, and your regular tranches of trying to raise equity, no problem. Multifamily, slightly more difficult, but not very difficult still, because we're operating in really strong markets that have projections for growth, just like inbound occupancy growth. And industrial, the asset class, I mean, of the three asset classes that we dabble in, industrial is the only one that we don't necessarily cater to the institutional users. So we're doing class A medical office, class A multifamily, but industrial is more like shallow bay product for like local tenants, 20,000, 30,000 square feet. We're not going after the big box Amazon kind of users, because we don't have the relationships at that level just yet, but
Sure,
growing towards it.
Okay, fantastic. For those that want to learn more about Onicx and the group and what you guys are doing, where's the best place to find you or keep up to speed with new updates?
In the LinkedIn handle, it's probably the best way.
LinkedIn handle? Okay, good deal.
Yeah.
Arjun, anything else that you'd like to share regarding you, the group, and what you guys are up to before we wrap it up for the day?
I mean, I'm really looking forward to 2023, because on the development side, obviously, there are definitely going to be some challenges because of the turbulence in the capital markets.
Mhm.
But from an asset valuation perspective, we do see some opportunities where buildings that or assets that don't necessarily should have had that high valuation, but got there because of the low cost of capital in the last economic cycle. We hope to be able to pick up a few, but I think that window will be really short, and there's a lot of money on the sidelines already.
Yes.
Like it's just waiting there.
So given that there could be some distressed opportunities, but yet there's also a ton of capital sitting on the sidelines, just waiting to pounce. How can one, or I guess how is Onicx playing to be strategically put into the middle to ensure that maybe you don't miss out on some of the opportunities that come your way, that ultimately will be competitive against with a lot of other capital that's chasing the same type of deal.
Yeah, the thing that I think or the strategy that might work best is finding the most distressed asset in the best location possible.
There you go.
For any asset class. So if you can find something in downtown which is priced below what it's supposed to be, buy it. Don't overthink it. Don't overanalyze it. And then as the markets kind of stabilize, get back into it. So we've seen and paralysis by analysis happen multiple times over. You're looking at it in so many different ways. That happened to many firms during when the construction costs were going up. Does this underwrite? Does this underwrite? How will the rents keep up? But it's just been extremely a solid bull run for the last decade and a half almost now. Something's got to give, but there's nothing wrong with the fundamentals of the industry, but I think a lot of us kind of entirely forget that the resources that we use as an industry and as just like the human race, really, they are finite. We're talking about shortages in chips. We're talking about shortages in construction material.
Sure.
And there is legitimacy in the fact that we ought to be concerned about that somewhat, because lumber's going to be it's not an indefinite amount of lumber that you can have, or same for the concrete, same for any other building material. What I'm basically saying is that I feel like this turbulence will yield something new. I hope as far as building construction technology is concerned.
Yes.
We've already seen a lot of new technologies come to the table. We've got labor markets are super tight, so you can't find people to do stuff for you. And
have you found that loosening up just a little bit now? Maybe that some of the projects might be on sidelines. I mean, have you found the labor market to open up just a little bit on the construction side?
On the subcontractors construction side, yes, there's definitely some more interest from subcontractors who would for the last 3 years not respond to anybody's phone calls. Now they are calling, asking is there work, but again, like the sub market is so specific, right? Like if you go around Fort Myers, there's lots of subcontractors that are fixing up the damage caused by Ian. So it depends on what market you're operating in, what asset class you're operating in. But yes, there's definitely some loosening, but it's still at historically low levels. It's not like anybody's wanting for stuff or wanting more business. I mean, everybody's slammed, everybody's still looking for more people. But no, I mean, to find a good development manager and investment manager in today's market is pretty hard. It just is really, really hard. And I don't think a lot of people are jumping ship right now, just because they would rather stay with a familiar known entity than look for,
Sure.
better opportunities at a different firm.
Yeah, no, I agree with you there. And Arjun, I really appreciate your insights and your time coming on the show here today. And folks, for those that are interested in learning more, I'll make sure to put that LinkedIn link into the show notes, as well as a link to their website. And Arjun, that's all I have today, my friend. Again, appreciate you coming on. It's been a pleasure having you.
Thank you, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. Take care.